Hello, and welcome to another episode of Debt Talk, the podcast where we explore the social and economic and policy issues affecting people and communities across Britain. And I'm your host, Ripon Ray. Britain is undergoing a huge transformation, investing heavily in digital and technological innovations. We are also hearing strong commitment from the Labour government to introduce a digital ID system. But what does this mean for those on low incomes? How will it affect marginalised and digitally excluded communities? To help unpack these important questions, I'm joined by Elizabeth Anderson, CEO of the Digital Poverty Alliance and Chief Marketing Officer of Napier AI, Rachel Tomini. Elizabeth, thank you so much for joining me on Debt Talk and for taking part in this crucial conversation. Let's start with the basics. Could you explain what we actually mean when we talk about digital and what it means for those everyday person, the Joe Blogs of our society?
When we think about digital, it means a lot of different things to a lot of different people. But if you are walking around the streets today, digital is absolutely everywhere. It may be that the extent of how you use it is maybe you're using it for mapping. Maybe you are using it to find the latest rail times. Maybe you're checking the weather and the news. It could be that if you are a child, the entire way you access your education has changed since COVID and since the pandemic, because what we've seen is education move rapidly online. That was very helpful for a lot of people during lockdown. But what it means now is that, for example, if you're completing homework or coursework, maybe you're using all sorts of different platforms, maybe you're using Teams, Google, all kinds of different storage systems for getting that homework marked. When you're applying for a job, 9 times out of 10, you're doing that online. If you're applying for universal credit, again, you're doing that online. If you're looking to access healthcare, again, online. So digital has gone from being one of those nice to haves that are helpful and convenient in our lives, but there's lots of different ways of accessing a service, to actually being the go-to for lots of public and indeed private sector services as well. So it really is everywhere. It's all around us.
But when policymakers and organizations say people need to be digitally connected, what do they actually mean in practical terms? And is it just access to the internet that we're referring to, or devices? Or does it go deeper, such as digital skills, confidence, and affordability, or anything else?
It absolutely does go deeper. So it's easy to imagine that, well, say you've got a smartphone, you're digitally connected, you've got a device, you've got a connection. Great, problem solved. No, that's absolutely not the case. For one, people need the right device for the task that they're trying to carry out. So going back to my example of a child doing their homework, that is very challenging, trying to do geography GCSE coursework, for example, on a smartphone. But yet that's a really common thing that we come across, teenagers trying to do high stakes work for school on a device that's wrong for them. Skills are incredibly important. So there's around 11 million people across the UK who lack basic digital skills. Now, I don't mean using AI. I don't mean accessing blockchain. I mean, actually, how do you turn on and set up a laptop? How do you set up an email address? How do you change a password? How do you use a search engine? These really foundational skills that you need. And the confidence piece is also incredibly important, that this wraps together the motivation for why people go online. It wraps up the trust that we have in different services and different platforms and different companies. But it also goes a little bit further. We also talk about the support that people need if everything goes wrong. Many of us will have had something happen with a laptop. We want to throw it out the window. It won't do the thing that we want it to do. Who do we turn to if we are perhaps a more isolated individual who doesn't have a big network around us? And also the accessibility of how some of these services are designed. That intuitive mindset that so many of us have when we encounter a new app. Actually, if you're digitally non-confident, you need something that has been built with inclusivity and accessibility in mind. So it also sits as much with the providers of these services as it does with how individuals access a device, access connectivity, and access the skills they need.
What proportion of the population is digitally connected, and also who are those individuals who are left behind?
Well, it all depends to a certain extent how you want to define it. But what we found is that around 6 in 7 people are digitally connected, but that means 1 in 7 people aren't. That may be because they don't have a device, or it might be because they don't have connectivity, or it may be that they don't have the skills. It's 1 in 17 people, which actually is still a lot of people who lack all of those. So that goes from being an or to being an and. They don't have the device, and they don't have the connectivity, and they don't have the skills to be able to use it. Predominantly, this is low-income families across the country. So that is around half of low-income families who are digitally excluded. Your risk of digital exclusion rises if you're unemployed. You become 2 to 3 times more likely to be disconnected. If you are older, or interestingly, if you are a recent school leaver, you are potentially most at risk of digital exclusion because of that cost of living crisis that is affecting so many families right now. And there's other factors as well. So if you're a woman, you're up to 22% more likely to be digitally excluded. So there are many different intersections that also come across, whether you're from a marginalised community or whether you have a long-term health condition or disability, so many different factors that pull in, meaning arguably it is the most vulnerable in our society who are the least able to access a lot of the help that has been moved online.
Based on what you mentioned so far in terms of those who are left behind, the government has been discussing the introduction of a digital ID system. Could you break down what that means for people in their day-to-day lives, and what benefits and challenges might that bring to communities that we work with?
So certainly the government has gone very big on saying that it's going to be incredibly convenient for everybody, whether you want to access work and prove your ID, whether you want to be able to prove your age in a shop, whether you want to be able to access childcare. These are all examples that have been given by the ministers. The concern for us is that it starts to put a financial barrier for people who perhaps are unemployed. They need to access work, but to have a digital ID, inherently, you have to have a digital device on which to have that. You don't just need the device, you also need the internet connection to be able to have that. You don't even just need the device and the connectivity. You have to have the skills and the confidence to be able to set up the app. Presumably, there'll be levels of security that will sit around this, multi-factor authentication, different protocols to make sure that other people can't access that ID. Now, whilst government do say there may be a physical alternative, we've already started to hear rumblings from business that actually it's going to be so helpful for them to have a digital version. We're already concerned that actually will a physical option be something that some employers will go, it's too much hassle. We'll leave that. We'll only take people who've got the digital version. And that really has the unfortunate opportunity of blocking some of the lowest income families from being able to access work.
Moving away from skill set and confidence, there is another argument and concerns around privacy. Now, it feels as though the balance has shifted from having privacy protected by default on being required to share identity information as a matter of course. What are your thoughts on this tension between digital progress and personal privacy?
It has a massive impact around how people feel about their relationship with the state, their relationship with big tech, and also how they feel about getting online. Fear is already actually something that matters a huge amount to older people, to parents, to others who do wonder what's happening to all of this information. An older person say to me once, I don't pay for anything online because once my card details are on the internet, they're there forever. And in some ways, that's potentially a naive way of looking at it, but actually, it's not untrue. Once you put that data in, it is, to all intents and purposes, in the cloud. If we look back to the data protection GDPR, Data Protection Act of 2018, that came in because there was a huge push that it was absolutely vital that people had the right to understand what information was being held about them, how that information was being used, what the purposes were. And yet, over the last 7 years, we've kind of let that drift. If we think about algorithms, do any of us really know what information is there and how that's being used? So, all of this information that is potentially being shared, as you say, by default and becoming a matter of course, we need a lot more information actually on how that'll be used, how decisions will be taken, and most importantly, with so many outages recently, how that information will be protected.
And finally, before I bring in our next guest, do you see a direct link between digital exclusion and financial exclusion? And are the people left out digitally the same ones being left out financially?
Absolutely, it's a huge crossover, and I'd say that's actually in a couple of different ways. For one, digital poverty follows poverty. So if you are on a low income, if you don't have funds in your family, how are you going to be able to afford a device? People say, oh, you can pick up a computer for 150 quid these days. We've got people who are trying to decide whether to turn the heating on, trying to decide whether they can afford to buy a loaf of bread. 150 quid is off in the realms of fantasy for whether that's affordable. Ditto for internet connectivity. You can get a social tariff for maybe £12-15. Again, outside the bounds of reality for these people. But also, so much of our financial lives has moved online now. So banks have closed. If you want to manage money, you need to be able to do that through an app. And actually, recent research from Virgin Money found that it's Gen Z who are most concerned about not being able to manage their money online because they haven't been taught those skills. So that link between digital exclusion and financial exclusion is absolutely huge, and it's something we should all be concerned about.
Thank you, Elizabeth, for your valuable insight, and I'll be no doubt coming back to you shortly for your top tips on tackling digital exclusion. Now, let's turn to our second guest from Napier AI, which works extensively within the financial services sector. You just heard Elizabeth talk about deep connection between digital and financial exclusion. Rachel, from your organization's experience, do you see a clear link between the two?
Oh, definitely. And I think something that Elizabeth articulated really well was that it's not always conscious exclusion. Sometimes it's where there's sort of legacy integrated risks or processes that people are expected to be able to participate in smoothly that is creating that exclusion for those who are maybe less digitally savvy. But we actually work specifically in the risk-based decision making for financial crime prevention for banks and other kinds of financial organizations. And what we see there is that if there's not great, accurate, risk-based decision making based on current data and trends around what crime really looks like, that can then cause decisions to be made either by analysts or by kind of new AI-based systems coming in that are actually exclusionary towards people who are simply just living their lives in that new digital setting. But there's also this piece of, if you don't have accurate decisions being made and you don't have confidence in those, it's a double-edged sword. So yes, some demographics within society, they might be refused services or products based on like credit risk, for example, whether they're, credit-worthy applicants, etc. But the other side of it is that criminals can get access to our financial services ecosystem when they should be kept out, because the risk-based decisioning is not accurate enough to make sure that we're truly identifying what is bad behavior versus potentially, say, the behavior patterns of someone who's not super confident using, digital financial services. So we have a big focus on what we kind of call compliance first AI. So that means the AI that we build into our solutions for banks and other types of, financial services, organizations, fintechs. We put a really big focus on the fact that it needs to be transparent, ethical, explainable, and compliant with regulators. So the Financial Conduct Authority here in the UK actually does a really good job of working with the organizations in the space to help them understand what a risk-based approach looks like, how to build for that, what is and isn't, a compliant approach to doing that and employing AI to do so. But we really advocate, particularly our chief data scientist, Dr. Janet Basterman, she is a big advocate for ensuring that those same principles around how tightly AI is regulated for financial crime compliance purposes should be spreading into the way it's used in other parts of financial services as well, especially on some of those different risk-based decisions. We actually recently published a piece of research that we call the Napier AI AML Index. So it's developed with Dr. Basterman, and it looks at the potential for improved risk-based decisioning around particularly financial crime and money laundering, the benefits that could drive for society and financial institutions in terms of what it's costing them to be compliant, but also the revenues that could be put back into offering different kinds of products, improving digital access, all those kinds of things. So we found that globally, economies could save $3.3 trillion each year that currently pass into the hands of financial criminals if they were doing a better job of implementing really good risk-based decisioning and really understanding human behaviors that sit underneath the transactions that they're looking at, etc., and the way that accounts are being opened in a digital age and all these kinds of different digital data points that we get. And that money, they're spending an inordinate amount, particularly the banks, to try and hold back the tide of financial crime. And rightly so, financial crime is a huge scourge on our economies, on our people. I think sometimes there's a misunderstanding that financial crime is maybe somehow a less sort of detestable crime, but actually it's really about the funds are coming from some of the most abhorrent things that happen in society, such as human trafficking, modern slavery. And so preventing people from being able to launder funds means making sure that crime doesn't pay. And if we could do that more effectively, more efficiently, then the cost savings could be, put back into potentially financial inclusion programs, whether that's improving, education and learning, or the way that apps are developed, or even kind of new products like microloans for small businesses that we've seen be put together by charitable endeavors around the world that are really effective in terms of driving financial inclusion.
Why do we continue to see economic discriminations against individuals who are perceived as financially vulnerable?
I think it's not necessarily conscious discrimination, but what we do see is that there's kind of this inherent tension between when people are economically vulnerable, particularly, they often become the target for financial criminals to help them to launder funds. So I think there's a lot of public awareness around being the target of scams. We've got a lot of public information out around, particularly the Take 5 to Stop Fraud campaign has been running for some time. But what we see currently, especially in the UK, is that you've got a widening economic gap between the richest and the poorest. And our research and plenty of other research out there shows that criminals really seek to capitalise on that. They capitalise on the sort of uncertainty people are feeling. Elizabeth mentioned before that it can be the difference of £150 might be huge for somebody. And they capitalise on the fact that I think a lot of the average people out there, particularly those who are maybe not super financially or digitally literate, maybe don't realise that it is a crime to allow funds to be passed through your account and to receive payment for that, even if it's a small amount. So that's called money muling. And I kind of liken it to, I think most people would understand that you couldn't let somebody store drugs or weapons or any of these things at your home. You kind of have to think about it that way, that you shouldn't let somebody pass money through your account when you don't know where that money's come from, what the purposes are, how it's going to be used in the future, etc. So there's a really big problem with money muling, particularly because people are, feeling the pinch and they don't understand the complexity of the crime behind it. And they probably think it's okay to allow that to happen and that they'll get a small payment as a result. So in the UK alone, I think in the last year, more than 225,000 people were identified as money mules. So that means they're letting criminals use their accounts to launder funds. And that's definitely raising concerns at the UK Financial Watchdog, because it's a more than 20% increase from the previous year. So it's definitely a rising problem. I think with the advent of things like social media, particularly where people, again, their digital skills and their ability to understand whether that's a legitimate business or offer could be a bit lower than perhaps we'd hope. It's become easier to recruit those money mules. So there's quick cash adverts on Instagram. These criminals, it's not just kind of one person operating quietly behind the scenes. They're big industries. It's called organized crime for a reason, and they have huge call centers or productions often running these schemes, and it has gotten easier for them with the advent of things particularly like social media. I'd also point out like a large proportion of money mules are very young. So 23% are under 21 years of age and 65% under 30 in the UK. So we have seen kind of anecdotally that it's often things like students who maybe have not managed their budget well and they're running out of money towards the end of the month, and they get this offer, whether directly to them or through a social media ad that says, if you just let us pass this cash through your account, we'll pay you a fee. And that's very tempting, right? So there's research from Europol suggests often like newcomers to a new country are often targeted soon after their arrival, as well as unemployed people, students, those in economic hardship. I think it's also worth pointing out that once you become a victim of some of the crimes that are then associated with financial crime and money laundering that happens afterwards, particularly things like modern slavery and human trafficking, criminals will use the ID of those individuals to take out loans. They ruin credit scores. They rack up huge debts. And so those people, even after they maybe escape that situation, they can end up being denied access to financial services, fair credit, those kinds of things.
Broadening within the context of wider financial market, which part of the financial service market are most affected by digital exclusion?
I think we touched on kind of maybe those who are very vulnerable within society, but I also think there are some organizations that are very affected by digital exclusion. So when you have legacy thinking or incorrect data points around how you're making risk-based decisions, some organizations like charities, for example, can often face a really sort of onerous paperwork labor overhead in terms of getting the funds to the locations where they need to do really good works on the ground. It can be really challenging for them to do that in a timely, cost-effective manner, because often they are sending funds to areas where potentially data would indicate that there are higher levels of financial crime, or there's just a lesser understanding, right, within financial institutions' own kind of risk analysis that they're doing. So there's caution for good reason, and the anti-money laundering and counter-terrorist financing global regulations exist for a really good reason, but they can make it very difficult for organizations, particularly like charities, to disperse the funds, particularly to sort of grassroots activities. And then we also see things like sending resources to conflict zones, or facilitating really important trade to happen out of those conflict zones, can be really difficult once sanctions are in place. So we've seen things like grain exports from Ukraine ended up being laundered essentially through shell firms. They're trying to hide exactly what's happening because there was a desire to not pay tax revenue, but that kind of income is really important, right? When there's an ongoing conflict and the government needs to fund the defense efforts, etc. So risk-based decisions in conflict zones, while we might not think anti-money laundering is necessarily life and death, actually, I suppose it can be related to. So at that larger level, whether funding is making its way through to the right places to support defence efforts, charitable efforts, whether there's a humanitarian crisis on the ground, but also then at the lower end, whether someone is potentially being wrapped up into a criminal enterprise without even necessarily realising it, that can have a huge impact then on the rest of their life, right? But actually digital literacy on both ends, so of the individuals, but then also of the financial institutions who are making the decisions about whether someone gets access to services, to products, they all need to be upskilled, really, and to be using the latest technology that's fit for purpose, with people who are well trained on it, and making sure, that there's a really keen understanding of what risk looks like and what crime really looks like, as opposed to too many assumptions making their way into the process. I think there's been some really big changes in the UK in particular over the last sort of decade, even a bit longer. We had things like instant payments, real-time payments come into UK quite early when you look at kind of the global trend around that. And there's real positives to it when it comes to financial inclusion. If you think about, a long time ago, people who were maybe more vulnerable would manage their household budget. They'd keep the money in the biscuit tin in the kitchen, and they would be able to see every penny, and they'd know exactly how much was going in and out of, their household budget any time. When we shifted to some digital payment methods, particularly things like direct debit, were quite challenging for people who are living on a very tight cash flow, because you weren't necessarily entirely sure when the next payment would go out, or potentially exactly how much it was going to be for. It made it very hard for people to manage. So I do think moving to the instant payment system means that people can have an accurate balance at all times, right? That's crucial when people are more financially vulnerable. However, it does mean that whether it's fraud or whether it's money laundering, these transactions are moving much more quickly. And so I think there's been some shift that possibly the average person doesn't understand around who's liable in some of those situations if you are scammed. There's been a lot of good regulatory change in the UK around that, but I think there are a lot of people out there who probably don't understand how pushing a payment through instant payments is different to making a payment with a card, and how a debit card is different to a credit card, and what the protections are. And so all of that needs to come into play. And then there's also the piece of, like, if you can open an account really easily from a mobile device, that is great. It is one step in improving digital access, as many physical branches are closing, that you kind of remove some of those barriers to do so. But it does also make it much easier for criminals to open new accounts, to conduct financial crime, etc. So,
I mean, we know the Financial Conduct Authority has been taking steps to make the sector more inclusive, with the rise of algorithm and making decisions around that, and pattern recognition systems. Are we at risk of further excluding those already? I know you covered it from products and marketing.
I think with any AI models that are being built, you have to really have a lot of conscious effort within your organization to make sure that you're not building inherent bias into those models themselves, and then amplifying that bias, because those models learn from the decisions that are made when the transactions or the behaviors that they flag are then reviewed by analysts. So one of the things that our data science team takes very seriously is making sure that there's great diversity within that team, so that you have different types of people building the model in the first place, right, to try and reduce some of that potential bias that could creep in. You have to have lots and lots of reviews and checks and controls, and that comes back to that compliance first AI approach. But we do see, the systems are only as fair as the data that feeds them. So, for example, if the data that you use to train your algorithmic decision making and pattern recognition systems, so if that data reflects historic bias, for example, it doesn't have good representation of those people who are maybe financially vulnerable, they're from low income, minority or unbanked groups, then you're perpetuating the issue, right? So there's some really interesting things being done by the Financial Conduct Authority. They actually have worked with the wider industry to create what they call synthetic data. That includes data that is representative of the entire UK population. So that organizations can be training their models on that more representative data. So there are some really important steps being taken. But one of the biggest things that the financial institutions need to do themselves is making sure that they have a human in the loop approach. So for financial crime compliance, it's actually not generally considered compliant for the AI to be making decisions on its own. What it can do is flag things, anomalies that it thinks look unusual, things for review. So you have to have humans who are trained, who can dive into those flags, who maybe can look at the recommendations from the AI, but who ultimately make the decision. And so there's a real kind of training piece there to make sure that they understand things like what potentially, victims of financial crime might look like, whether that's somebody, who's a victim of modern slavery, human trafficking, how that might show up, how and processes in place. But there's also organizations out there who are doing great work. Like Project Nemo is one that works with financial institutions specifically around disability inclusion. How might someone who is maybe not capable of making financial decisions themselves, how might that show up in their behavioral patterns if they start transacting online, etc., and being able to have processes internally to flag those things through, right, and to support those who are vulnerable. So we're big proponents of like AI shouldn't run before it can walk. You have to have really good controls and safety measures built into your organization first, before you start trying to automate it. Anti-money laundering, financial crime prevention, it's high risk for banks. The potential fines are huge, and the reputational damage and risk is huge. So it is a sector where I think there's a good amount of caution in making sure that the underlying data, processes, risk-based assessment is really, really strong before they start trying to layer these kinds of automations in.
And finally, Rachel, what can financial institutions, from let's say banks to fintech companies, do to break those barriers? I know you covered it. And where does this consumer duty framework comes in, which the FCA has been embedding into the financial service market?
Yeah, so the consumer duty framework obviously has this emphasis on making sure that things are efficient and effective, essentially, for users, customers of financial services here in the UK. So I think when we look at that from the perspective of where we work, again, it's that piece of the risk-based decisioning being correct so that there's not a huge amount of inefficiency within financial services organizations by flagging lots and lots of what we call false positives. So that's where it identifies a behavior or a transaction through the algorithms, through the models, to be reviewed. And that review often happens manually. So there are huge teams doing this for potential financial crime. But if you're getting the same false positives over and over, it means essentially you're identifying the wrong things, right? So there's that piece. You want to make sure that your true positives are correct. So you're looking to make sure that the things that you flag as financial crime are definitely financial crime, but also that you're not missing anything, right? You'll never get to 0 false positives because essentially that would mean you're probably missing some of the real crime. But getting more efficient and effective in how you do that would actually be one of the ways to work towards meeting some of the obligations of consumer duty. You're showing a tangible improvement in how you're delivering services for your customers. We look at some of the historical changes that the UK financial services regulators and markets have put in place, things like open banking, or when we were part of Europe, we met the requirements for PSD2. A lot of the big drivers around that was consumer choice, and rightly so. New products came in, new fintechs, new neobanks, etc., sprung up. APIs and open banking made it possible to maybe see all of your financial products, your bank accounts, your various credit cards, etc., in one place. Micro investing became possible for the average person. It made it a lot easier to cancel subscriptions, like directly from your banking app. All of these are really positive progressions, I think, in terms of breaking down barriers for financial inclusion. But they also introduce new risk into the system. And I think there's potentially an overcorrection on how they try and address some of that risk, but in the wrong way, where the risk is being misidentified, which is creating huge inefficiencies and too much time and effort focused on the wrong places, instead of focusing on really stamping out true crime. And I think it's really important to remember that, most of us have probably either been a victim of a scam or fraud, or had a family member or friend at some point. That's not where the crime stops. In a digital world, to legitimize those funds, they then have to put them through a series of different transactions before they can extract them and ultimately profit from crime. And so tackling that piece is one way of making sure that crime doesn't pay. We've done a really good job, I think, of raising awareness as a nation and putting in safeguarding controls to try and tackle the predicate crime, which is the fraud piece, the scams. But there's more to be done in terms of meeting at least the spirit of the consumer duty around protecting our individual people and also our society from the plague that is financial crime at the moment.
Thank you, Rachel, for sharing your expertise. Before we wrap up, though, I want to return to both of my panel members for their top tips on how listeners, campaigners, and policymakers can challenge digital exclusion and promote fairer access to digital and financial opportunities. Elizabeth, let me start with you.
One of the absolutely key points is to raise awareness of this. Understand what it means to be digitally excluded. Think about how it would impact your life if you suddenly were offline. If you are a business, think about how someone who's digitally excluded might access your services. Businesses, for example, can take action through designing in that inclusion within their products, within their platforms, training staff to be able to recognise digital poverty, even things like committing to donate end-of-life devices. All of these things are really practical steps that organisations can take. For policymakers, we're really looking to government to work together, not apart, and unite with a long-term digital inclusion strategy that can build on the Digital Inclusion Action Plan that government released earlier this year. That's been great to see, but there's so much more that government can do to convene action around this, even though it needs a whole society approach. And then if you're an individual, there are things that you can do. There's help that you can reach. So if you're already connected, but you want to gain skills, you can use something like Idea.org UK. That has bite-sized gamified learning on everything from maybe how to set up a password to how to use blockchain, literally everything in between. It's run by a charity, and it's a great way for people, whether they're a child, a retiree, working age, to focus on some fun, brief snapshots, not a long PowerPoint deck that you sit there for 2 hours watching and slightly maybe switch off from. If you know someone older or somebody who's perhaps experiencing disabilities, who needs meaningful help, then AbilityNet is the place to go. They can actually come in, help to set up a device. That can be incredibly helpful to have that one-on-one help. And if you know somebody who just needs access to a device, they fundamentally can't afford that, and they need that help, and they need that support. Or indeed, if you can help us to be able to reach those devices, you can contact us at digitalpovertyalliance.org, and we help as many people as we can each year to get online, often for the first time.
Thank you, Elizabeth and Rachel. And now your final thought.
In our experience of working with regulators, we do find that many organisations are not necessarily doing as good a job as they could be of real-time risk-based decisioning, which unfortunately means they are letting criminals get access to our financial services ecosystem. So our view would be that we want to call for better risk-based approach from financial institutions. That's not just about technology. It's about understanding your customers. It's about understanding, the demographics of the market that you're working in and how those behaviors might show up. New fintechs, they're doing a good job of bringing new offerings to the market. But they have, some of them have been letting in more bad actors, and we need equal expectations of financial crime prevention and controls across financial services. So our call would be kind of for the policymakers to continue what they're doing, which is expanding anti-money laundering regulations to include everyone who touches that ecosystem. Because the more financial crime risk that's introduced, there's a greater chance of the wrong people being excluded for the wrong reasons from access to the systems. We found as well in our research that in the UK, financial institutions could save 2.5 billion annually by correctly implementing AI for AML. And we think the FCA's supercharged sandbox is a really big step towards achieving that, then being able to test their new AI approaches. So we'd encourage as many financial institutions, etc., as possible, the listeners, to make sure that they are collaborating with the regulator. The FCA is a particularly collaborative regulator when you look at the kind of global landscape. Regulation itself just isn't enough. You have to have collaboration between the policymakers, the actual banks, fintechs, etc., who are operating, and the technology providers like us. And establishing strong AI controls today, it's not just about being compliant and ticking that box so that you don't get a slap on the wrist later. It really is about stopping the flow of illicit funds, putting money back into the economy in a way that builds trust, that, gives more and more people more equal access to the financial system that we do have.
A huge thank you to my guest, Elizabeth Anderson from Digital Poverty Alliance and Rachel Tomini from Napier AI for sharing their insights on such an important topic. For those listening, if you'd like to share your experiences, suggest a topic, or join the discussion, you can reach me at ripon@debttalk.org. Join me next time on Debt Talk, where we'll be exploring economic abuse and its impact on communities. I'm Ripon Ray, your host. Thank you for listening, and until next time, take care.